one little thing, I'm just going to interrupt you because it's your first quiz. What I would do before you do anything else on the quiz is I would go through for each of the 10 questions and I would put out in the margin, is this annual compounding? Is this monthly compounding? I would write like either a 1 or a 12 just so that you don't make that mistake. done, you can just bring the quiz and the quiz sheet, the answer sheet, both of them, up to me, I'll grade them so that you can see what you did.
It was in beginning, because of the files in beginning.
minutes or so. Okay, it's officially been 30 minutes, but I'm gonna give you 5 more minutes. got about a minute left. I'm still waiting on 1, 2, 3, 4, 5 of you.
We'll go over it after, right?
No. Okay. Who's next?
Where you didn't touch the spread.
No, my dad is not. You're doing all that though. The second unit. What if you said that? Did you do number seven?
Income under.
Here you have the very sheet.
Question sheet.
Here I have the.
Divided by the point of the presentation.
No, that's for final grade based on test. The one here, you'll have to plug in the presentation, very flat, they're very bold boxes, you plug in grades. So
I work better with the letters, I made Irv
It's Tuesday.
No, I'm sorry.
I just don't like waiting for.
Okay.
I don't look at the ball, I need to go over there and like.
Oh, I'm sorry.
You know, let's just go knock on our door. Hey, I exist, this is what I have, yeah. I understand. Let me know when you're ready.
All right. So we had at least one perfect score, multiple 90s, 2 80s, couple 60s, so all in all, good job.
You curve it, I hope, right?
No, not at all.
Okay, let's get started. All right, so what we're going to do now is basically we're going to jump into the new material, which in essence deals with fixed rate mortgages, and which obviously in terms of the quiz will come next week. Okay, so we'll go ahead and get an early start on that, so it gives you time to kind of reflect and let some of that information sink in. In essence, at this point, just so if you're keeping your notes and trying to keep them separate, this is where you'll start taking notes for quiz number 2. Okay, so fixed rate mortgages is our next topic, and what we do here is we sort of take a look at starting off with a very basic, simple, sort of traditional fixed rate mortgage, and then we complicate it. Okay? We complicate it by adding in loan origination fees, we complicate it by adding in prepayment penalties, we complicate it by adding in servicing fees, and then talking about each of those as we sort of go through the process. But the first thing that we sort of will just kind of begin with is just talking a little bit about this basic sort of fixed rate mortgage. Now, first of all, most mortgages are going to be 12 payments per year. And we're going to start off with just a $100,000 mortgage. And let's say that we've got a 30-year term, which is going to be standard for a lot of traditional residential mortgages, and in some cases commercial mortgages as well, but 30 years or 360 months, okay? Very seldom are you going to see an amortization period greater than 30 years. There are a handful of instances, if you get out there and you Google and you look around, there are a handful of mortgages of where some lenders have gone with some 40-year and 50-year terms, but those are by no means, in any stretch of the imagination, the norm. They're usually set up that way, and a lot of them are in California for residential properties, and the reason they're set up with these ridiculously long terms is to try to get the monthly payment down low enough to where it's affordable, okay? But the reality is it doesn't really make a whole lot of sense. I mean, 30 years is a nice term because you think about it, you know, why 30 years? Well, you know, if you take the average ordinary person, you know, let's say they start working somewhere in their 20s, maybe they buy their first house either at 25 or at 30, then by the time they're 55 or 60, approaching retirement age, hopefully they have their home paid off, okay? And that was kind of the general sort of thought process, you know, for this 30-year mortgage. Now, for commercial properties, most commercial properties have an amortization period of 15 years, okay? Although there are plenty that are out there that have 20, 25, and in some cases 30 years, but most commercial mortgages you're going to see with a 15-year amortization period, okay? Now, so we have this 30-year term, and I'm going to go with a really high interest rate, just because I know all the numbers by heart, 10% interest rate, which actually was the going interest rate whenever I first started teaching this course in the 1980s, and so I've stuck with that number in my head for all these years because I can remember that the monthly payment is $877.57, okay? So your monthly payment, $877.57, and that is going to be the payment that you're going to pay for 360 months. Now, a couple of little things that we want to try to do to make sure that you understand what's really going on in terms of principal versus interest is, let's just take that number for a moment, multiply it by 360, just to see what the total actual out-of-pocket costs are for that mortgage. Yeah, $315,925.20. Okay, so for that $100,000 mortgage with interest, you're paying $315,925. Now, if you're paying attention, we've talked about this. What dollar amount is principal?
100.
100. So if we subtract out 100,000 from that, in other words, the loan amount, then that means of that total amount that we're paying, $215,925.20 is interest. Okay, does that make sense, everybody? Yes or no?
Yep.
Okay. How does that interest number get so big? Because of the compounding effect of the interest rate. And if you actually take a look, which we're going to do, at how much of your first few payments are actually made up of principal and interest, and how little of those payments goes toward reducing the principal balance, It's really disturbing. In this case, if my memory serves me correctly, out of the very first payment you make, I believe it's like $44.24 goes to principal. The remaining $833 and like 33 cents goes to interest.
How did you come up with that 44 again?
I know it by memory.
No.
Okay? All right. But to do it, let me show you. Okay? So, first of all, if we take 100,000 and we multiply that by the interest rate of 10% divided by 12, because it's obviously monthly, okay? So 100,000 times 0.10 divided by 12, you should get 833.33, which is the interest portion. Okay, does that make sense? Yes? Okay, so that gives us that number. To get the principal portion, all we do is just subtract one from the other. We take 877.57, subtract out 833.33, that's going to give us the 44.24. Does that make sense? Now your calculator will give you all of this, by the way, without having to do that. Okay, we can use what's called our amortization function. All right, so as an example, once we've put in all the normal loan information here, okay, we can just sort of skip forward and specifically do as follows. Put in 1, and we're going to use a new key on the calculator, input. It's on the left-hand side, second key down. And I'll explain this. 1 input 1, shift, amortize. That key is in the upper right-hand corner below the future value key. Equal, equal, equal. Now let me explain what this particular function is doing. All right? 1 input 1. Okay, think of your calculator all of a sudden as a memory bank. All right? And once you have put in the loan information for this particular loan, $100,000 loan, 10%, 30 years, you've calculated the payment of $877.57, now you can go into the calculator's memory bank and say, for any period of time, give me the principal paid, the interest paid, and the ending balance. And so, to recall, just for the first period, or in this case the first month, we would do 1 through 1, or 1 input 1. And that's going to basically say to the calculator, give me only month number 1 through month number 1. Okay? Then we do the shift, amortize. So now we're accessing this amortization function within the calculator, and we're going to show you how to do this by hand as well. But just right now, we're accessing that function, the amortization function, and then you're going to hit the equal key. So let's see what happens. Okay. Once again, make sure you got your loan information in there. Okay, once again, $100,000 present value, 10% interest rate, 30 years, solve for payment, get $877.57 negative. All right, then 1, input 1, shift, amortize, equal. And it's going to give you, up in the upper kind of left-hand corner of the calculator, it's going to say PRIN for principal. And it's going to give you negative 44.24 rounded. We hit the equal the first time. When you hit the equal again, now it's going to give you the interest, 833.33. You hit the equal key again, now it's going to give you the ending balance on the loan after 1 month. In this case, $99,955.76. So that is the balance at end of month 1. Okay, is everybody clear on that? Yes or no? Now, let's talk about this for just a second. You've made your first payment to the bank. Your payment was $877.57. Yes? That was the amount of the check you gave to the bank. It was $877.57. But only $44.24 went toward reducing the balance of the loan. Okay? The other $833.33 is just simply that's interest that they collected. Is everybody clear on that? Yes or no? So whenever you calculate the balance, all you're subtracting out is the $44.24 from the $877.57. Does that make sense? Now, if that doesn't become intuitively obvious at the moment, it will a little bit later when we actually put together an actual amortization schedule. Yep.
Principal, keep getting 833.33. I'm not getting 44.24.
Let me look. That's what she puts it in wrong. She's giving you both that or the put the problem in there again. You've got to solve for the payment first. Okay, so one mistake, and this is not an uncommon mistake, is whenever you put your loan information in, before you can use the amortization function, you must first solve for the payment, because the calculator needs to know what it is we're working with. And so if you leave that piece of it out, the calculator is kind of like, where do we go from here? Okay? So you've got to make sure that you're solving for that.
Thank you.
All right.
So Dr. Forty,
Yep.
one input one, what am I telling the calculator? One?
Okay. You're telling the calculator period number 1 through period number 1.
Number one.
So if it's monthly, which in this case it is, it's month number 1 through month number 1.
So if I
If it was annual, it would be year number 1 through year number 1.
So if I want to calculate how much principal and interest I paid over the last 24 months, I can just go from
One
month
input
to
24.
24, right?
If you want to know for the first, let's say, 10 years, one input 120. But what if you wanted to know for just year 2 alone? 13 input 24.
13, 24, yeah.
Or what if you just wanted to know the last 6 months of the first year? 7 input 12.
Perfect.
Okay? So you've just got to think about logically what period of time that you're sort of searching for the data that you're searching for, and it depends on what what is the purpose of that.
So the start and end period.
I'm sorry.
The start and end.
Yes.
run.
All you're really you're putting in the start period and you're putting in the end period. That's all you're doing. Okay. Moving forward. All right. Now, while we're here, what the heck? Let's go ahead and just sort of show you by hand how to put together a basic amortization schedule. Okay? By hand. All right. So for this particular loan, we've got our information that we've already sort of put in, but in order to do this by hand, what is an amortization schedule going to look like? Well, first of all, you're going to have your payment number, okay, or period number, either or. Period or payment number. And in this case, it's going to be like month 1, 2, 3, 4, 5, all the way down, in this case, to 360 months. Okay, so that's going to be your first column. Okay, now, as you get really excited about this, then in the next class, starting at 12:30, we're going to build one of these in Excel, okay? So you're going to see this again in a little bit of a different form. But the next column over is going to be the beginning balance of the loan in that particular period. Okay? Then the next column is going to be the payment amount. Next column, and sometimes depending on kind of how one person chooses to set it up, whether they want to put the principal first or they want to put the interest first, this can vacillate back and forth, but we'll go ahead and put interest paid, and then principal repaid, and then ending balance. Okay? So this is the setup for just a normal, simple loan amortization. Whether you get a car loan, you get a home loan, you get any kind of loan, this is pretty much how it's set up, okay? You start off with the beginning balance of the loan. So in this particular case, with the loan that we are playing around with, we have a beginning balance in that first month of $100,000. Make sense, everybody? Yes?
Yeah.
Okay, we've already calculated with our calculator the payment amount, which is $877.57. Well, that's going to be the same amount for a fixed rate mortgage all the way down.
You know what the formula is to calculate the payment without using the financial calculator?
I do, but it's a bit rough. Okay? I mean, it's in your book, we can do it, but it will eat up a lot of time.
All right.
Because it's not a simple one. Okay. All right, so calculating now in this case, the interest paid, we're going to use what we did before. So in that first situation, we took the $100,000, which was our loan balance, times the interest rate of 10% divided by 12, and we got the $833.33. So that is our interest paid and how we got it. Is everybody clear on that? Yes or no?
Yeah.
Okay. Now there's a method of my madness in working through this, and you will hopefully see here in a moment. Okay. So in order to get the principal repaid, all we have to do is just subtract the interest paid from the payment amount. All right? So the principal repaid is going to be $44.24. All right? Now to get the ending balance, we're taking the beginning balance minus the principal repaid. Okay? So that's where we got the $99,955. Wasn't it 76?
Yeah.
Okay. All right. Now, that becomes our new balance. Okay? That makes sense, everybody?
Yeah.
All right? So now we know what our payment is, but now our interest. You're saying, oh, well, we just basically go and we use this again. No, because now we have a new balance, so we got to calculate the new interest. Okay? So it's kind of a pain in the backside to have to do this, but, and this is where, once again, the calculator and Excel, help us out, but let's just go ahead and do it for this one, just to sort of show the process. And you should get $832.96. Do I follow?
You gonna go through the whole thing again, or?
I'm going to go through one more line.
No, I mean, to do the new payment thing? the interest principal portion, you'd rather just do the 2 and put 2? Or-
Yeah, you can, yes, you can,
You get 10%.
okay? But I'm doing it all by hand up here is what I'm saying. Okay, so taking now the 877.57, so that means our principal repaid was around $44, 61 cents. Okay, everybody following the math?
Yeah.
Okay, all I'm trying to do, I'm not trying to get you hung up on the math, but I'm trying to get you hung up on the logic, not hung up, but I'm trying to get you clear on the logic as to what's going on. All right? And then now our ending balance will be $99,911.15, okay, which then will come back over here, $99,911.15. Once again, go down here, do the math, so forth, so on. Okay, you get the general idea, yes?
Yeah.
Okay. Now, using the calculator to do it, as you brought up, or somebody, or Michael brought up, if we wanted to fill in those numbers, so let's take a look and see if we did it right for month number 2. As he mentioned, all you should have to do is, once you've got all the information in for the loan, is now to access month 2, is do 2, input 2, shift, amortize, equal, I get 44.61, there we go. Equal again, 832.96, yep, and 99,911.15. Okay, so good, all right? Just double check to make sure that it works. Okay, so for the month 3, let's do that. 3, input 3, shift, amortize, equal, all right? So 44 and 98, 832.59, and 99, 866.18, okay? Which then becomes, once again, our new beginning balance over here. Okay, now we can do month 4. So 4 input 4, shift, amortize, equal, 45, 35, 832.22, 99, 820, 82. Okay, is everybody getting into the rhythm on that? Okay, all right, and then for month 5,
Is there a way to just move to the next month instead of having to type in like the inputs?
not that I'm aware of. It does just cycle through the same one over and over again.
Yeah.
If you keep it equal, but I don't believe there's a way to just like go automatically to the next one.
Okay.
All right, so the next one, in this case, 5 input 5. And the reality is, you're not going to be doing this that often because obviously you're going to be building this in Excel and doing it instantaneously. This is really just to kind of show you how you can do it on the calculator. Okay, so 45.73, and then 831.84, ending balance 99,775.09. Okay. Now, just for fun, let's do 360 input 360 to get that very last month. 360 input 360, shift, amortize, equal. Okay, now it switches, and so our principal paid is the bigger number, 870.32. Our interest is only $7.25, and our balance is 0.
$3.40.
Well, mine ends up being 0. Oh, did you ever calculate only set for 2 decimal places?
Yeah.
Okay. One other little trick using the calculator. Okay. To set the, what I do is I have mine constantly set for 9 decimal places, and the way that you do that is you hit the shift key, and then underneath the equal key is DISP, which stands for display. And then right after that, whatever number that you type in this case 9, that will then kick out your decimal places to 9 decimal places. But if you want to just round everything off to 2 decimal places, you can do shift display 2, and it'll cut everything off at 2 decimal places. Okay? Now the downside with that, especially whenever you're doing these mortgage calculations, is sometimes allowing your calculator to carry everything out to the extreme, then you're not going to get the rounding error at the end.
What do you hit after the number?
That's it.
No, the shift display.
9.
Oh, I must have done something wrong. Got it.
Okay. All right. Moving forward. All right. So, okay. So at this point, we talked a little bit about the fixed rate mortgage. We went through an example of the fixed rate mortgage. We showed you kind of a basic and helped you work through a basic amortization schedule, understanding how to calculate the interest, how to back into the principal amount, how to get the ending balance. Okay. Everybody kosher with that? Now, let's sort of talk about, for a moment, kind of a little bit of history and talk about how we ended up with fixed rate mortgages to begin with and what there was in play before fixed rate mortgages. So, what I'm going to title this is History of Mortgages, according to me. All right. For the longest period of time, you had people who would borrow money and they would work out some sort of a relationship with whoever they borrowed it from and, you know, pay them some rate of interest, usually simple interest, and in many cases, interest-only mortgages, okay? And this was pretty much the case up until the early 1900s, that you had what were referred to, well, or at least what are referred to now, as interest-only or simple interest mortgages. Now, any of you that have ever watched any of these old sort of spaghetti westerns, and they talk about, you know, the evil banker taking away, foreclosing the property of the farmer or the rancher, in most cases, these were interest-only mortgages. And you're saying, okay, why? Why does this matter? Where are you going with this? Okay, follow me on the logic train. The way the interest-only mortgage works is, let's say that I'm the lender, okay? You come to me and say, all right, I want to borrow money to build out my family farm, my ranch, okay? And I say, great. Here's what we're going to do. I'm going to loan you, let's say, $100,000, and you're going to pay me simple interest or 10% a year on that $100,000. So what that means is every year, Paul's going to come into me sometime during the year. It could be monthly, could be quarterly, could be annually. And Paul's going to have to give me how much money each year?
10,000.
Okay? Paul's going to give me $10,000 a year in interest. Is everybody comfortable with that? Okay? Does that make sense? Yes or no?
Yeah.
Okay. Now, that's okay. Paul can, you know, do whatever he has to do with his crops, you know, sell off his, you know, some cattle, build whatever he's going to build. Everything is going great, you know, several years into this. But chances are, as the lender, I have probably said, there's going to be a fixed term for this loan. In other words, I'm not just going to allow you to pay me $10,000 a year in interest forever and ever as a perpetuity, I'm going to put a fixed date that the loan is going to come due. Now that might be 5 years, it might be 10 years, it might be 15 years. But usually the duration was fairly tight. And there was sadly a lot of corruption that went into this, because the lender is basically saying, if I put a 5-year term on this interest-only mortgage, here's what's going to happen. Well, first of all, at the end of 5 years, what does happen? You've got to pay back in full the entire $100,000. Well, what does that mean you're going to have to do at the end of 5 years? Either basically do what we talked about earlier, either sell the property, cash out of it, refinance it with the lender who's going to be, at this point, probably unwilling to refinance it because they are purposely hoping you don't have that $100,000 so that they can basically repossess, take possession of your property, and then potentially sell it to somebody else. Okay? Does that make sense? This is, once again, this is where those old westerns start to make a lot more sense. It's like, why are all these people losing the family farm? Well, in many instances, it wasn't because maybe the farm wasn't producing or the ranch wasn't producing. It was because there was sort of this whole mindset by a lot of the lenders of, we're going to take repossession of your property after a relatively short loan term. But see, here's the beautiful part about it from the lender's perspective is, over that 5 years, what was Paul doing? Paul was improving the property. He was building a house. He was, adding crops. He was, putting up fence lines and doing all this stuff. So whenever the lender gets it back after 5 years, all this work has been done and put into the property, and the value of the property is worth a heck of a lot more than probably what was originally lent. No wonder lenders still have reputations, in many cases, of being unscrupulous and potentially predatory and those sorts of things, because there are origins of where that kind of activity took place, time and time again. And there wasn't a lot of regulation to prohibit it. It was very clear. You signed a contract, 5 years. Okay? So the only way that you were going to have that money after 5 years is you would have had to do what? Literally put 20 grand into your mattress, so to speak, every year on top of the $10,000 that you were paying in interest in order to potentially have the $100,000 5 years later. Does that make sense? Well, how many people do you think did that? Not many. Okay, and still don't.
No, you still do. Hard money lenders is exactly how it goes.
No, and that's the point. There's a reason for that.
Yeah.
Okay, interest-only mortgages are really, they're great if you know what you're doing and you realize the consequence that you're potentially taking. But in the event of you're not able to save that extra bit of money, the reality is most business owners, most private individuals are not able to set aside all of that extra money on their own to be able to pay down that balance, especially over a roughly short time horizon. Okay? Now, do these types of loans still exist? Absolutely they exist. Okay? And part of the reason why they exist is because you have lenders saying to you as a borrower, we can get you a lower monthly payment on the loan if you do an interest-only mortgage than if you do a traditional mortgage. Because the reality is, if you take this number, the $10,000 a year in interest, and you divide that by 12, look what number you're going to get. Does that number look familiar? 833.33. That's just the interest off of our original example, isn't it? So the point being is, you're not paying any interest at all. You're only paying, you're not paying any principal at all. You're only paying interest. So your loan balance never, ever, ever goes down with an interest-only mortgage.
Foreclosures and no rate on.
Right. Okay. And as you just mentioned, one of the things that helped to exacerbate the problem of the meltdown in 2007, 2008, this was one of the culprits, along with adjustable rate mortgages, okay, which we're going to get to as well. But right now, let's just focus on the interest only. So let me just make sure that you're paying attention. So on an interest only mortgage of $100,000 with a 5-year term, how much is your balance at the end of 5 years? $100,000. Okay, just making sure you're paying attention, all right? So in other words, you have not paid off anything, okay? You still owe the original full balance. Okay, let's say that you had an interest-only mortgage for 30 years for $100,000. How much is your balance at the end of 20 years? $100,000. How much is it at the end of 30 years? $100,000. Okay, the point being is, regardless of the term of the loan, an interest-only mortgage, the balance never goes down. Okay, is everybody clear with that?
Unless the contract is finished, right?
I'm sorry?
Unless you finish the agreement, the term, or whatever.
Well, yeah, but you got. But the point being is, you got to pay off that full balance.
The interest, though.
The interest is continual. You're going to have interest payments all the way throughout,
Okay.
but you're not paying down anything on the balance of the loan.
You're not lowering the principal at all.
Correct.
All right.
You're making interest-only payments, period. All right? Now, sort of following in the footsteps of the interest-only mortgage was something called the constant amortization mortgage. That's not what we currently have. That is not the constant payment mortgage, it's the constant amortization mortgage. Now, the reason for the introduction of the constant amortization mortgage is it was kind of a middle ground, stopgap solution to help fix the problem of the interest-only mortgages. And also, let me kind of go back a step with the interest-only mortgages. Part of the reason why you only had kind of interest-only mortgages was due to technology. Think about the technology that was available to you in pretty much the 1700s and the 1800s and you know, early 1900s. You're pretty much limited to what? A piece of paper and a pencil. And maybe at some point a slide rule, but pretty much a piece of paper and a pencil. Okay? So if that's the case, the mathematics to actually do the calculations for the mortgage, you pretty much had to be able to do just, you know, basically multiplying, adding, subtracting, dividing. It was basic math, is my point. Okay? Well, at some point, you kind of began to realize that with a little bit of additional math, we could do the constant amortization mortgage. Well, the way that it works is as follows. You actually do pay off the loan over a quicker period of time, but it is where you have, let's say, the $100,000 loan, and you have 360 months worth of payments. You simply divide that. This is not dealing with the interest at the moment, this is just dealing with the payment piece. So what we're going to say is that with the constant amortization mortgage, you're going to pay off a fixed amount of the principal each month. And that fixed amount is going to stay constant. So in other words,
Payment's going to be variable.
I'm sorry?
Your monthly payment would change.
Your monthly payment's going to be variable, and your interest is going to be variable, but the amount you're paying off is going to be fixed. And that's a key thing. In other words, you're decreasing your loan balance by $277.77 a month. Okay, does that make sense? So just to kind of once again put things into kind of perspective, assuming that you had a zero interest loan, would be one way to kind of think about this just for a second, assuming no interest at all were being charged, then your monthly payment would be $277.77 a month, and your balance would decrease at, once again, $277.77 a month. Now, if your interest rate is 10%, your balance is still declining by $277.77 a month, but the interest that you're going to be charged is going to change from month to month as your balance declines.
As you go into a loan, your actual payment will go lower, down to 277.
Right. So, and once again, we'll show you how to do this in Excel, but we'll do a couple of quick steps, obviously by hand, just to illustrate the process. So,
You probably said this already, but the 277 is coming out of the principal amount now, not interest?
correct, because this is a constant amortization mortgage. Now, all this is in your book, so in the event that you're like, I don't understand what he was talking about, okay, look it up in the book,
And what
okay?
determines the change of interest rate?
Well, the interest rate on the constant amortization mortgage is more than likely going to be fixed, okay? The interest rate's going to be fixed, but the amount you owe each month is going to be different, and this is what I'm about to illustrate, okay? So for the first month, your interest rate calculation, if it's 10%, is going to be the same as the regular ordinary mortgage. 10% divided by 12, 833.33 is going to be your interest portion of the constant amortization mortgage for month 1. But your principal portion is going to be this $277.77, meaning your total payment for the first month is going to be 11, 11, 11, 10. Yeah, it's more money, but
In the long run, it's less.
but what it
Right.
does is it ultimately pays off the loan a little bit quicker. Okay? You're making basically larger payments. Does that make sense conceptually? So, the next month, if you will, you're going to basically take 100,000, you're going to subtract out 277.77, which is going to give you a loan balance at the beginning of month 2 of 99,722.23. Multiply that by 10% divided by 12. And that means that for the second month, your interest payment is now going to be $831.02. You're going to add that to the $277.77, meaning the second month payment is going to be $1108.79. So you're going to see it goes down every single month, okay? Where your final monthly payment there at the very end of the loan is pretty much only going to be like the $277, okay, with very little interest. Does that make sense conceptually? Like I said, we will do one in Excel, but I just want to show you right now, just to kind of give you an idea of what it's about. Yes?
Can that be done in this thing?
Yep. Well, only by hand.
Ah.
Okay, there's no shortcut for this. However, let's just play a couple of logic games, because this is what I love to do on the little quizzes on this. Okay? So what if I asked you what the loan balance is on this loan after 15 years?
Multiply 277 times 15 years, subtract 700.
Well, not times 15 years, times 180 payments.
Well, that's what I meant.
Okay.
I was just
I know, you're shortcutting
12
it.
times 15.
I understand. But for example, what we're saying is if we wanted to find the loan balance after 15 years, we would simply take the 277.77, multiply it by 180 months,
Shouldn't be 50,000.
and you get roughly 50,000. So, I mean, just probably by the rounding, 49, 99, 60. So basically, you've paid off really half of the loan. I mean, it should be 50,000 because obviously half of it's done, equal amortization over the life of the loan. So yeah, the loan balance should be right at $50,000. The reason it's not, once again, rounding by a penny, okay, here and there. Okay, does that make sense? So if I asked you, well, what is the balance after 10 years, what would you do?
33,833.
Or somebody's like, once again, you're simply taking 2777 times 120. There's your loan balance, or the amount that has been paid off. Okay, does that make sense? So my point, what I'm trying to make sure that you understand is, I could actually pick any month during that 30 years, and you should be able to easily come to what is the loan balance. Everybody follow me on that? Because all you're going to be doing is pretty much just multiplying the 277 and 77 times whatever the number of months are, and subtracting that from the total. Yep.
And just to be clear, that 49,000, that's not the balance?
That is the balance. Well, in this case, it's both about, because well, it's halfway
Oh,
through.
it's halfway through.
Yeah.
But in the next one.
It's technically the amount that has been paid off.
Paid off.
Right. So
Okay.
if, for instance, if it was 10 years, we then have to take that number and
Subtract it from
by
the 100.
total, yeah.
Yep. Okay. All right. Let's move forward. Okay. So now we come back, technology-wise, early 20th century. You know, we've got some. Once again, we've got some slide rules. We've got all this wonderful math that basically is being done, and we come up with a way to calculate what we're now calling the constant payment mortgage, which is what we are most comfortable with, or basically what we use. And the idea behind the constant payment mortgage is simply that it allows the borrower to know from one month to the next that they have a fixed dollar amount obligation that doesn't change over time, and gives them the comfort that they are seeking with respect to that constant sort of payment. But it also serves the purpose of, over the time of that loan, more and more of the balance over time is going to be paid off, so that at the end of the loan term and the loan amortization period, the balance is going to be zero. Does that make sense, everybody? Okay. Then, we're not going to get there with the calculations today, but I want to then kind of move on with the variable rate mortgage, or adjustable. The creation of the adjustable rate mortgage, once again, pretty much due to technology and available technology. Came out in the 1970s. We finally had all these wonderful sort of massive data processing computers that could actually, once again, kind of do the math, redo the math, and so forth. And so you had banks beginning to say, hey, you know what? Why don't we create these loans that, instead of having a fixed interest rate from month to month, year to year, let's come up with a system, because we've got some really crazy interest rates that are occurring in the 1970s, where they were going through the roof in terms of the interest rates. Well, let's create this new sort of loan that what we can do is maybe lock in a short-term rate that maybe is reasonably low, and then as rates either go up or they go down, that burden or that risk is going to be shifted to the consumer, to the borrower. Okay, so that we as a lender aren't going to have to bear that risk. We're just going to sort of shift that risk onto the consumer, and so once again, they have to bear the risk of the rates going up and down, up and down. Well, now the way in which the adjustable rate or variable rate mortgages work, I mean, every loan is different. Okay, let me make sure I preface that. Some adjustable rate mortgages adjust monthly. Like one of the very first mortgages I had back in the early 90s, it was an adjustable rate mortgage. Every single month I got a statement in the mail that says, okay, your rate is now 8 point whatever. And then the next month it was maybe higher. The next month it was maybe lower, you know, and it varied from month to month, recalculated, you know, and that was the way that it worked. Other adjustable rate mortgages, they're maybe set up for maybe the first 6 months is one rate, the next 6 months is another rate, and then maybe it's adjusted annually. Others, one more thought on this, others are set up specifically that the initial interest rate is ridiculously low, and they call it a teaser rate. And the idea behind that teaser rate is it gets people to come to your bank to get your loan because you are teasing them with this below market, ridiculously low interest rate. So it would be like me saying, all right, come to me, like a lot of retailers do, and once again, banks are retailers. You've got to think of banks as being retailers. And they're saying, come to me, I'm going to give you a mortgage interest rate of 0% for the first 6 months. And then everybody's, oh my God, that's amazing, you know. And then, so they all run, they grab the 6-month loan, only to find out that after 6 months, they're going to be locked into that particular mortgage, maybe for the next however many years, at some ridiculously high interest rate. But the whole idea was to get customers in the door. Does that make sense? Borrowers in the door. Okay.
You said you'd get something in the mail where your rate would change pretty much every month?
Yeah, what's a monthly statement?
Is that government regulated, or is that just typically, is that just the bank?
Good
They
question.
charge whatever they feel like?
Good question. Okay, so the question was basically, how regulated is that? All right, whenever you get an adjustable rate mortgage, there are a whole series of disclosures that your lender has to make to you that this is an adjustable rate mortgage, and here are kind of in big bold letters, you know, what your initial rate is, potentially if there are any limitations on how much it can go up or potentially how much it can go down. Yeah. And so one of the things that we will be talking about as we're working through some of the problems for adjustable rate mortgages is saying, okay, maybe your initial rate is, you know, 5%, and over the course of 1 year, it's limited to a 1% increase. So it can't go more than 1% increase over the course of a year.
And if you're the bank, you're just gonna increase it 1%, no
Yeah.
matter what, pretty much.
Yeah, or, well, now, normally, okay, let me back up on that. Normally, the lender is going to tie the rate to some sort of an independent index, if they're a legitimate lender.
Yeah.
And, you know, whether they're going to tie it to something like the Consumer Price Index, or LIBOR, or, you know, some sort of federal funds rate, or whatever it is, Treasury, securities rate. And so, and then typically they're going to add on what is basically a margin on top of whatever that base rate may be, and then that is kind of their profit perspective. But we're going to get into the details of that later. But right now, just understand that yes, we have adjustable rate mortgages. Yes, they can adjust every single month. Yes, they can adjust different periods. They do start, in many cases, with that introductory sort of teaser rate. Those are the things that you need to be making sure you're focused on.
They're
Okay?
being used again?
I'm sorry?
They're being.
Oh, yeah.
Oh, wow.
Absolutely. No, they're always in use. It's just a question of what percentage of the overall market they may make up. Okay? And, you know, that's the thing. I mean, you know, for the most part, the traditional constant payment mortgage, or fixed rate mortgage as it's also called, that's the predominant player. However, a lot of borrowers, and we're going to talk about this, that may have unusual circumstances with their credit backgrounds or their work histories or whatever, or the, you know, once again, you've got tenants within a commercial property that may have questionable sort of backgrounds or beginnings or whatever it may be. Then, you know, there are all sorts of these alternative sort of mortgage products that are sort of put out there that we're going to be talking about. Everything from graduated payment mortgages to price level adjusted mortgages. You know, there's a whole, you know, litany of products out there that have been created and creatively created in the sense to try to potentially give a lender some interesting advantages.
I have 5-1 on, and, but it's not bad, because my interest rate is 2.75, but it has caps, so I can't go up more than 2 a year and 8 for the life. But if it goes up, I can lock it in for a small, like $500 fee for another 5 years, so like there's really minimal risk, and knowing how the interest rates, it's not the seventies.
And this is the thing to make sure that I'm being clear on. You know, part of what it sounds like I'm saying is all lenders are evil, all lenders are taking advantage of you, all lenders are horrible, awful people. That's not what I'm saying. What I am saying is you need to be looking out for a number of these things in order to protect yourself and understand what you're getting yourself into so that you don't get taken advantage of, because these are going to be the more common kinds of ways in which they can do so. Okay? Make sense? Yep, RJ?
This is probably something we'll go over down the line, but are different types of investments, I guess, better for variable or constant? Like,
yeah.
More advantages for?
Well, it really depends on, we will talk about this, but basically the whole reason for adjustable rate mortgages, if you're the lender, is if you think that rates are going to be, you know, going up over time, you want to be able to sort of potentially lock in your borrower to an adjustable rate mortgage and then have them obviously pay you more over time. You know, but if you think rates are going down, then you as the lender are probably going to be more inclined to issue fixed rate mortgages.
Right.
So it's just kind of a
speculation.
It is.
Yeah, then you'll get, if you have adjustable, you'll usually get a swap to hedge against that too.
There's all different sort of mechanisms there. Okay, which we'll get into. Okay, Monica.
I was just thinking about SBAs when they do like the working capital or construction costs, and is that more like that type of, it's constantly adjusting? Is it safer? Is it government regulated?
It depends on on who's what. For the SBA lenders, I am not certain as to what their restrictions are. That's not something that I really deal with. Only dealing with the mortgage fees. Okay. Now,
what's an SBA lender? Is that small business?
Yeah, Small Business Administration. Those are basically business loans that usually for everything from inventory to working capital to some cases real estate, but usually it's equipment and other things that you may need to start your business or run your business.
Higher interest rates for them?
Yeah, it's usually, usually they're going to be a little bit lower. Than part of the idea is that they're government facilitated and that you have SBA approved lenders in which that once again they follow set guidelines by the Small Business Administration.
Okay.
All right. How do lenders make money? Okay. Simple answer is for mortgages, they charge you interest. Okay? That's the beginning piece. So they make money off of the mortgage interest. Okay? They make money, and I already mentioned these earlier today, we'll just go ahead and write them out. Loan origination fees. Monthly servicing or administrative fees. And
Selling mortgage.
prepayment penalty fees.
Think about selling mortgage.
We're just talking about mortgages here, okay? All right. Now, obviously, there are other ways lenders make money in terms of taking in deposits, and then ultimately loaning out those deposits to basically borrowers. But that's we're not concerned with that with
No, I
this.
was saying like where they'll sell the mortgage on that.
Yeah, okay, yes, they can sell the mortgages once they have created them.
Right.
Okay, and that's another piece to this that we will get into much later, which is, and I'm not gonna put this under this particular category, but what you're referring to is they can sell the mortgages, and specifically, they can securitize the mortgages.
With default on the borrower as well, they make money that way too, right?
Well, that, once again, they're
In multi ways, yeah. Right.
but what we're really concerned with in this particular part of the course are those first four, okay? The interest rate, loan origination fees, monthly servicing, administration fees, and prepayment penalties. So let's talk about, it's pretty straightforward what the mortgage interest is, okay? You know, obviously, they're lending you this amount, they're charging you this interest, they're making money off of that. Okay, we're comfortable with that. The second one, loan origination fees, also can be referred to as discount points. All right? But we're really focused on this, we're going to call it loan origination fees. So what exactly is a loan origination fee? All right, I'm the lender. All right? Charlie comes in to me, wants to get $1 million loan from me. I'm saying, great, I look forward to doing the loan with you. Here's this really nice, relatively low interest rate relative to my competition down the street. But in order to potentially be competitive and make sure that I get the money I want as a lender, I'm going to say, I'm going to charge you a 5% loan origination fee. Okay? Now, you can obviously choose to accept or reject that, but not every lender is going to change this, or not every lender is going to charge the same percentage or dollar amount of loan origination fee. Some lenders don't charge one at all. Some charge ridiculously high ones. But the idea behind it is that it's an upfront way for you to pay me for my time and effort and energy in putting together all these loan documents for you, getting all of the appraisals, getting all of the other sort of due diligence that I need to do as a lender, basically paid for up front, instead of waiting to make that money off of the mortgage interest or any of these other fees. Does that make sense? Okay? So a 5% loan origination fee would be how much on $1 million?
50,000.
50 grand. Okay? So